Pricing, profitability analysis, and processes. Pricing is one of the most powerful ways to improve or destroy profits. A Deloitte pricing effectiveness benchmark study found that companies that actively pursue pricing as an important part of their strategy typically outperform industry peers on several financial metrics. Companies that are pricing leaders are 26% better at managing true profitability. A McKinsey and Company analysis of S&P 1500 companies calculated that a price rise of 1% if volumes remain stable would generate an 8% increase in operating profits, an impact nearly 50% greater than that of a 1% fall in variable costs such as materials and direct labor, and more than 3 times greater than the impact of a 1% increase in volume. A McKinsey on Finance article noted that committed leadership on pricing strategy improves a company's operating profit margin by between 2% and 7%, often doubling historic profit margins. Despite pricing's crucial importance for improved profitability, companies do a poor job of it. A Bain & Company survey noted that most companies call pricing a high priority in our global survey, but 85% say they have significant room for improvement in pricing. A Harvard Business Review article reviewed pricing studies and concluded this and many other studies indicate that pricing managers routinely set prices too low, sapping their company's profits. With so much profitability at stake, surely companies would focus on improving pricing. Unfortunately, the Bain survey found that poor pricing practices are insidious. They damage a company's economics but can go unnoticed for years. This course is one of 3 pricing courses to help you improve the pricing practices at your company or to help your clients make better pricing decisions. I'll begin by explaining cost-plus pricing. This is a popular pricing methodology but is fraught with some significant weaknesses. The next few lessons dive into the financial analysis of pricing decisions. The best pricing levels may be contingent on a company's production capacity. Setting the price for a new product or in a new market can be very difficult. I'll offer some tips. Once we set that starting price point and begin selling at it, we can gain knowledge of how prices, costs, and volumes interact. We can then begin adjusting prices to optimize profits. I'll offer some ideas on how to do this. Finally, pricing is a team sport. Each part of a company has a different perspective and role in setting prices. I'll explain why some believe that finance should lead pricing discussions. I also offer 2 other pricing courses. They are Pricing Profitably for Your Product's Value. Pricing is a function of the value provided to customers. This course focuses on customer perceptions of value and their willingness to pay for that value. You'll learn the calculation for value-based pricing. I also touch on pricing ethics. Pricing profitably in the face of competition. The focus of this course is how other companies can impact prices. I show how to analyze the profitability at stake by responding to competitor pricing. You'll learn common pricing strategies relative to market pricing. Finally, I'll show how to identify and reduce poor discounting practices. Each course looks at pricing from one of 3 perspectives. Pricing for profitability looks at internal analysis and processes. Pricing profitably for your product's values focuses on customer perceptions and actions. And finally, pricing profitably in the face of competition focuses on competitive pressures. Each course starts with one of 3 pricing methodologies. Pricing for profitability focuses on cost-plus pricing. Pricing profitably for your product's value explores value-based pricing. And pricing profitably in the face of competition focuses on competition-based pricing. A robust pricing program considers all these perspectives and methodologies. These courses focus on financial management and profitability analysis of pricing. Pricing is a major role of a company's CFO. The McKinsey on Finance article mentioned earlier noted, in best-of-class pricing organizations, the CFO commits at least 20% of his or her time to the pricing effort. This compares with an average of only 10% found in an annual executive survey. I'm Rob Stevens, founder of CFO Perspective. During my career, I've been the CFO, SVP of Finance, or Director of Operations of companies with just a few employees to companies with $3 billion in assets and hundreds of employees. I've chaired the pricing committee or worked with others to set pricing at these companies. I make courses for company employees as well as for business advisors like CPAs, coaches, and consultants. When I say you, I'm referring to business owners or staff. If you are a business advisor, you can translate you to mean your clients or the business you work for. The titles for the financial staff that analyze pricing are different for each company. I refer to the accounting, finance, or FP&A, financial planning and analysis function, or department that usually do this as finance in this course for simplicity. I also use the term product to mean both products and services for simplicity. No one wants me to constantly repeat the phrase products and services. I will give examples of the course concepts using relatively small dollar amounts. I do this to make it easier to read, say, and fit on a page or a screen. Please feel free to add as many zeros as needed in your head to scale the examples to an amount relevant to your company or situation. With those guidelines in place, let's dive into pricing for profitability. Cost plus pricing. Cost plus pricing involves adding a markup to the cost of producing or acquiring a product to establish the final price. The formula for cost plus pricing seems straightforward. Selling price equals cost plus markup. However, let's dig a little more into the components of cost and markup to see some of the challenges of this pricing policy. Cost refers to the total cost incurred in producing, manufacturing, or acquiring the product. It frequently includes variable costs, for example, materials, labor, and direct production expenses. Two other types of costs may be included in costs or may be factored into the margin. Fixed costs, for example, rent, salaries, and depreciation. Other expenses, such as overhead and administration costs. Like so many analyses, choosing which cost to use as a starting point can greatly influence the outcome of the analysis. Some options include marginal costs are the change in costs due to a change in production volumes. These are often the only relevant costs of a forward-looking decision. All other costs are sunk and irrelevant. Standard costs or past average costs are often easily calculated from financial reports. They may be the outputs of an analysis from costing methods like activity-based costing. As noted earlier, these costs may only include variable costs or may reflect full absorption costing, where overhead amounts have been allocated to products. Many companies can easily use inventory reports to find a cost per unit as a starting point for pricing. Other people may say a more relevant cost is the cost to replace inventory. This is reflected in a classic debate on how gasoline should be priced. Should the price of gas be based on what the station paid in the past for the gas in their tanks, or what it will cost them to replace the gas they are selling? The total costs of a product may go far beyond the costs of production. There may be customer service costs, product returns, and other costs that need to be added to direct production costs. Cost plus pricing also suffers from a chicken versus the egg problem. How can you set costs unless you know the volume you might sell? How can you estimate the volume without starting with an assumed price? In other words, which truly comes first as an assumption in cost plus pricing, the cost or the price? Costs per unit vary greatly based on the volumes you will produce. At certain volume thresholds, you will incur a step fixed cost, which will greatly increase costs above the pure variable costs. Step fixed costs are costs that don't change over a range of production, but then greatly change when a threshold is reached. The per unit allocation of fixed costs also varies greatly based on assumed volumes. If you have $1 million of fixed costs, the per unit allocation is $1,000 at 1,000 units of production, but only $100 at 10,000 units. That's a $900 difference in price using a cost plus pricing methodology. I'll return to this chicken versus the egg problem later in this lesson. The markup is the amount added to the cost to determine the selling price. Markup can be expressed as a fixed amount or a percentage of the cost. Like costs, there are options for determining the markup: the profit margin the business wants to achieve, a company's cost of capital. As noted earlier, if costs are defined as only variable costs, then a company might include fixed costs and overhead in the markup in addition to a profit amount. There are rules of thumb in some industries for markup amounts. When I worked in restaurants, pricing was often set at 3 times the costs. I had a client in another industry that billed custom work at 2 times their cost. These and other common markup options can reasonably answer the question: what is the correct overall amount of markups for my company? The question they don't often answer well is: what is the correct markup for each product? For example, grocery stores are notorious for having loss leader products like milk and eggs that attract people to the store, in the hopes that those shoppers will then buy other products with high margins. The margins of the loss leaders and the other products will be radically different. I noted that restaurant prices were set around 3 times food costs at restaurants. At a restaurant I worked at, soda and our little loaves of bread were priced at 10 times their costs. Margins on alcohol were high. Margins on main dishes were low. This is why servers are coached to upsell customers on drinks, appetizers, side dishes, and desserts. Those are the high margin products. Cost plus pricing has been historically very popular for the following reasons. Cost plus pricing is straightforward and easy to understand. Both employees and customers can quickly grasp how prices are determined, which can lead to more transparent and predictable pricing. This can make it appear more objective and defensible to company employees, especially sales staff, who must negotiate pricing with customers. Administering pricing policies with this methodology may also be easier. Cost plus pricing also requires much less information and effort gathering information than other methodologies. The costs often come from costing information a company already has. Adding a markup to the costs is a simple calculation compared to other pricing methodologies.